Welcome to the deep dive. For months now, all you've heard is the promise of artificial intelligence, AGI, explosive productivity, the total transformation of, well, every industry.
Right. It's been the dominant narrative.
But beneath that shiny veneer of technological optimism lies an equally massive and I think often ignored story.
Equal plumbing.
The plumbing, exactly. The staggering financial engineering that's being used to build the foundational infrastructure of this new era. We are talking about data centers, cutting-edge GPUs, the power supply. All of it requires these colossal, front-loaded capital commitments.
And that is precisely where our focus has to shift today. I mean, we need to move from analyzing the technology's promise to really understanding the sheer cost of that promise.
It's a big one.
It's a huge one. Current institutional estimates suggest something around $2.9 trillion in planned capital expenditures, CapEx, is going to be poured into this global AI infrastructure boom, and that's just through 2028.
2.9 trillion.
So our mission in this deep dive isn't to question the potential of the technology itself, not at all. It's to conduct a really rigorous analysis, almost like a post-mortem case study, but in advance.
A pre-mortem.
A pre-mortem, exactly, of the highly leveraged and sometimes, deliberately opaque financial structures that are funding this entire build-out.
Okay, let's unpack this then. We've been looking through bond filings, institutional research reports, credit market analysis, and the narrative that emerges is, well, it's both staggering and incredibly complex. We are clearly in a massive financing cycle that seems to be driven more by competitive necessity, that classic fear of missing out, FOMO, than by, stable, proven economic fundamentals.
And that's the Gore thesis we're presenting to you today. It's pretty clear.
Mm-hmm.
The AI boom is largely funded by unprecedented corporate leverage and a rapidly expanding layer of what we're calling shadow debt.
Shadow debt.
Debt that is deliberately moved off the core balance sheets of the world's largest, most visible companies. And just to put the scale in perspective, global AI-related debt specifically tied to infrastructure build-out, chip purchases, data center financing, has already surged to $1.2 trillion globally.
And the pace is accelerating so rapidly. Major tech firms issued a record $141 billion in corporate debt in 2025 alone.
Right.
That already surpasses the entire $127 billion that was issued in all of 2024.
Think about that. The market is absorbing this risk at an absolutely exponential rate, and it's justifying the issuance based on future cash flow projections that are, they're pretty speculative.
And this rapid absorption, it brings us to this profound disconnect you mentioned at the start. You have this massive capital flow, this huge volume of debt being issued.
Right.
But when you look at the outcome side, the actual results, the picture is far more cautionary.
Yeah.
There was that MIT research released recently.
Yeah, this was a bombshell.
It suggests that an astonishing 95% of enterprise AI pilot projects delivers zero measurable financial return on investment.
Zero. Not a low return. Zero.
95%. That figure, if it holds true, it should be the flashing red light on every single executive's dashboard.
It should be.
It suggests that this competitive race is just so intense that companies are willing to throw massive amounts of capital at projects purely because they feel they must keep pace with their rivals. It doesn't even matter if there's a proven, scalable business model that actually justifies the CapEx.
Exactly. And that dynamic, it forces these companies into a really tight corner. I mean, if demand isn't translating into sufficient organic revenue today, they have to find financial ways to sustain the build-out until that demand does materialize.
Right. They're building the stadium hoping the teams will show up eventually.
And that essential financial maneuvering, the stuff that keeps the debt machines running, it all starts with masking the sheer volume of that debt. And they do that through these off-balance sheet vehicles.
So let's begin our deep dive there into the specifics of this financial engineering. We need to talk about the primary tool being used to achieve this financial invisibility.
Special purpose vehicles.
Yeah.
SPVs.
Exactly. For our listeners, we're looking at a mechanism that has existed for decades, but its application in this AI boom is reaching a completely unprecedented scale.
And we should approach this slowly and clearly because it's foundational to understanding the whole structure. A special purpose vehicle is, it's really nothing more than a separate legal entity. Think of it like a highly focused shell company.
Okay.
It's created for one reason and one reason only, to hold specific assets and their corresponding liabilities. By doing that, it legally insulates the parent company from that liability.
Is it a shield?
It's a shield.
Yeah.
And its core purpose in the AI infrastructure world is deceptively simple but incredibly powerful. It allows the parent company to borrow billions of dollars to fund infrastructure expansion.
Without that debt ever appearing on its main consolidated balance sheet. And the importance of that, I mean, it just cannot be overstated. Major tech firms, your Metas, your Googles, your Microsofts, they fight fiercely to maintain their strong investment-grade credit ratings.
Of course.
And why? Because a strong rating gives them the lowest possible cost of borrowing across their entire business. Everything from stock buybacks to general corporate operations.
It affects everything.
If they were to just load, say, $50 billion in new data center debt directly onto their core balance sheets, their debt-to-EBITDA leverage ratios would speak, their rating could get cut.
And their cost of capital for all their operations would rise dramatically.
Yeah.
The SPV avoids this financial penalty. It acts as a debt firewall.
That firewall analogy is perfect. The debt is real, the infrastructure is real, but the liability is, it's segregated.
It is. And the best way to understand this mechanism is through a concrete multi-billion-dollar example. Let's look at Meta's Hyperion data center complex.
Okay.
In October of 2025, Meta entered a highly publicized partnership with the private equity giant Blue Owl Capital. The goal was to establish a joint venture to finance this massive, multi-phase 2-gigawatt data center campus.
Specifically for AI workloads.
Specifically for AI. This wasn't for their social media business. This was for the future.
And so what did that capital structure look like when the dust finally settled?
The total capital structure was $29.5 billion, a huge number. But here's the critical split, the part that's enabled by the SPV structure.
Okay.
$27 billion of that was debt. And that debt was held directly by the joint venture entity, the SPV. Only $2.5 billion was funded through equity.
So it's incredibly leveraged.
Incredibly.
Yeah.
And Meta retains only a 20% equity ownership stake in that SPV, with Blue Owl holding the majority. So crucially, that massive $27 billion debt load is considered debt on the SPV's balance sheet. You could argue it's on Blue Owl's consolidated financials, but it's definitely not on Meta's.
So Meta gains the strategic asset, this cutting-edge 2-gigawatt compute capacity it desperately needs to hit its AI targets. And it continues its aggressive expansion, which is projected to reach something like $72 billion in annual AI infrastructure spending.
A staggering number.
Yet that $27 billion foundational debt doesn't appear on its primary consolidated balance sheet. It achieves its aggressive CapEx goals while preserving its precious investment-grade leverage ratios.
Precisely. It's a mechanism to access control over assets without the direct financial footprint of ownership. But the SPV structure, it can be repurposed to achieve even more complex strategic goals. It's not just about masking leverage.
Okay, like what?
Well, consider the fascinating arrangement around xAI's GPU leasing SPV.
Elon Musk's company.
That's the one. They structured a $20 billion special purpose vehicle. The explicit purpose was to purchase vast quantities of NVIDIA GPUs.
And then lease them back to xAI itself.
Exactly. I see you followed this one.
I see the mechanism, but what's truly fascinating here to me is the connection to the supplier. NVIDIA is the vendor supplying the chips that the SPV is buying.
And that is the twist. Because NVIDIA itself contributed $2 billion in equity to that exact same SPV.
Wait, so the seller is helping finance the buyer?
That's it. This creates a highly complex financial loop. Analysts have started calling it reverse vendor financing.
Reverse vendor finance.
The supplier, NVIDIA, is effectively backstopping the buyer's demand xAI's massive purchase by funding a portion of the buyer's ability to purchase its own future sales.
So NVIDIA recognizes the immediate revenue from selling all those chips.
Correct. Huge top-line boost.
While the underlying asset risk, the risk of whether xAI can ultimately monetize that compute power, is shifted into this separate entity, the SPV.
It's a brilliant piece of financial engineering.
That structure is almost guaranteed demand for the supplier. It certainly muddies the waters when you're trying to figure out what the organic market demand is versus the strategically engineered, internally supported sales. You're selling your product and helping fund the customer who's buying it, all while isolating the underlying debt risk.
It creates a beautiful financial feedback loop designed to accelerate the build-out. Now, not every major firm uses that explicit equity-linked SPV structure, but they achieve a functionally similar result through long-term liability commitments.
Okay, so who does that?
Consider Oracle's approach. Oracle is pursuing these massive data center projects, securing a $38 billion debt package in late 2025.
Right, through a firm like Vantage Data Centers for those big projects in Texas and Wisconsin.
That's the one. And again, Oracle isn't owning those data centers directly. It's very similar to Meta's approach in principle.
So what's the mechanism here?
Instead of housing the debt in a direct SPV on its books, Oracle is signing long-term offtake agreements.
Explain that.
Essentially, Oracle commits to buying nearly all the capacity from those facilities for years and years to come. It's a guaranteed long-term revenue stream for Vantage.
And that guarantee is the collateral.
It's all the collateral Vantage needs. That commitment is sufficient to secure the financing. Vantage then issues the debt into the credit markets. So Oracle gets to use the infrastructure, but it doesn't own the assets or carry that massive debt load.
So they can claim impressive capital efficiency metrics.
Exactly. Lower capex to revenue.
While still controlling the operational output. It seems like regardless of the specific financial vehicle used, a dedicated SPV, a joint venture, a long-term offtake agreement, the ultimate goal is the same.
Create a layer of shadow debt.
What is the estimated scale of this shadow that sits outside the public eye?
Well, quantifying it is difficult by design, of course, but sources citing detailed SPV pipelines in these long-term lease commitments, they estimate this shadow debt to be somewhere between $120 billion and potentially as high as $800 billion.
$800 billion.
And that's just the AI infrastructure financing currently sitting outside traditional corporate balance sheets. And it's growing. Morgan Stanley research suggests we could see an additional $800 billion in STV-based funding pumped into this infrastructure through 2028.
That capital is only visible to sophisticated credit investors who are doing the deep due diligence, right? Not to general shareholders just reading the quarterly consolidated reports.
That's right. It's hidden in plain sight.
So why should the average investor or a business leader care that the debt has been shifted a few layers deep? If the debt is legally separate, doesn't that just mean the parent company is financially safer?
That's the argument for it. But it introduces two major systemic consequences that really undermine market transparency.
Okay, what's the first?
The most obvious one is leverage obfuscation. The hyperscalers appear materially less leveraged than they truly are.
So the numbers are misleading.
They're not the full picture. A company reporting, say, $100 billion in consolidated debt might easily have another $50 to $100 billion in these long-term lease obligations or SPV commitments that aren't fully reflected in the headline debt-to-EBITDA numbers. For the shareholder, this means relying on the traditional price-to-earnings ratio is just insufficient. You have to look at these off-balance sheet commitments to gauge the true risk.
And the second consequence involves what happens when things go wrong, the default risk.
Right. And this is the principle of covenant arbitrage. SPV structures are deliberately engineered to bear the first loss risk.
Walk me through that scenario.
Okay. Let's say the cash flows from the Meta Hyperion data center disappoint. Let's say the utilization rates are too low because that 95% ROI failure rate persists. The SPV then fails to service its debt.
So the lenders come calling.
The lenders come calling, and they seize the specific assets of the SPV, the data center itself. But here's the crucial part. Because the debt is often non-recourse to the parent company, this failure does not automatically trigger a cross-default on Meta's public, consolidated corporate debt covenants.
So the parent company benefits from the massive infrastructure expansion when times are good.
But the off-balance sheet entity bears the first loss risk when times are bad.
Exactly. This separation creates a distinct moral hazard. The parent company has a strong financial incentive to take on these high-risk, high-reward, aggressive projects through an SPV because they know their core balance sheet remains protected from immediate catastrophic cross-default triggers.
They privatize the benefit
And socialize the localized first-loss risk onto the structured credit investors who funded the SPV in the first place.
It's a clever system. But if special purpose vehicles successfully mask how the debt is financed by hiding it off balance sheet, the next stage of this financial engineering—
He calls circular finance.
Exactly. That masks the equally important question of who the real customers are for all this massive new compute capacity.
Okay, let's unpack this self-reinforcing loop, because this is where market skepticism should really start to climb. Define circular financing for us in practical terms.
It's a closed-loop system, and it's designed to validate expansion. It works like this. Hyperscalers and the major chip makers, they invest heavily in promising AI startups. They give them billions in capital injection.
Yeah.
That capital is then immediately, or at least systematically, spent by that same startup.
Purchasing the investor's own cloud services or hardware.
You've got it.
Yeah.
This manufactured consumption generates revenue for the hyperscaler, which in turn provides the financial justification for issuing more debt and funding further expansion capex. It's an internal cycle designed to sustain the build-out until, they hope, organic demand catches up.
The most prominent example of this has to be the interwoven relationship between Microsoft and OpenAI.
Oh, absolutely. The textbook case.
Microsoft has sunk, what, $13.8 billion into OpenAI, gaining a significant stake? But the real kicker is the strategic component of that deal, isn't it?
The commitment was truly massive. I mean, it's unprecedented. As part of that arrangement, OpenAI agreed to purchase up to a staggering $250 billion in Azure cloud capacity through 2032.
$250 billion.
$250 billion. And Microsoft immediately recognizes this massive long-term commitment as future revenue. This commitment then becomes the essential backbone, the justification for their massive CapEx guidance. It allows them to issue record amounts of debt because they can claim they have validated demand that extends years and years into the future.
And Google runs a parallel playbook with Anthropic, though maybe on a smaller scale.
A very similar structure. Google and Anthropic. Google reserved 1 million of its custom TPU chips for Anthropic's use. Anthropic utilizes those chips to train and offer inference services, and that generates revenue that flows right back to its investors, including Google.
So the system is designed to accelerate adoption.
And, crucially, provide a highly visible anchor tenant to validate the need for the underlying TPU infrastructure in the first place.
This whole structure seems highly vulnerable to the claim that the company is essentially just buying its own initial demand. And we've seen market analysts raise some pretty serious concerns about this practice, right? Particularly with the chip makers who are driving so much of this CapEx boom.
They have. Goldman Sachs explicitly flagged this risk to its clients. They warned that a significant portion of NVIDIA's projected demand growth originates from companies that are funded or supported by NVIDIA itself.
And their conclusion was?
They suggested that because this revenue stream lacks an organic arm's-length quality, it could be dilutive to NVIDIA's multiple.
So, in plain English, investors shouldn't value that manufactured revenue stream the same way they value revenue from a truly independent customer base.
Exactly. $1 of circular revenue is not the same quality as $1 of organic revenue.
So what is the real implication here? I mean, if you strip away these enormous intercompany circular flows, what happens to the perceived market demand?
The implication is a looming real demand collapse. Private market analyses that we've seen suggest that if you remove these intercompany flows and commitments, the actual external customer-driven demand for AI infrastructure today is materially lower.
How much lower?
Perhaps 30% to 50% lower than what the aggregate investment figures suggest. We are building massive capacity based on a projection of demand that is, to a very large extent, currently being manufactured and guaranteed by the builders themselves.
And the risk profile here is compounded even further by some subtle but really powerful accounting games.
Cloud credits.
Exactly. This is the subtle distortion that allows companies to inflate top-line growth without any external cash actually changing hands.
This is a point of significant opacity in the market right now, and it's important to walk through the double count.
Okay, let's do it.
Imagine a hyperscaler invests $1 billion in a promising AI startup. As part of that investment deal, they agree to give the startup, say, $500 million in free cloud credits. It's essentially a subsidy for compute time.
Right.
Here's the accounting trick. The startup books those $500 million in credits as revenue because they're receiving services they would otherwise have to pay for.
Okay, that's step one. The startup inflates its revenue line using non-cash credits.
Correct. And step two is equally important. As the startup uses those $500 million in credits to run its models on the hyperscaler's infrastructure, the hyperscaler recognizes that drawdown as revenue on their books.
So it's a classic financial double count?
It is. The same $500 million of capital, the credit grant, appears as revenue on both the investors and the investees' financial statements. It inflates the perceived top-line growth across the entire ecosystem.
So $500 million of internal capital creates what looks like $1 billion of market activity and revenue recognition.
It completely distorts the true cash flow picture. And this practice is so prevalent that credit investors are now forced to manually distinguish organic revenue growth from circular financing when they're assessing lending risk. It contributes heavily to the overall market opacity that regulators, like the Bank of England, are now explicitly warning about.
And all of this complex engineering, the STVs, the circular financing, the credit games, it's all ultimately a bet, right? A bet that the business models will eventually materialize.
It's a huge bet.
But we keep coming back to that fundamental risk, the ROI cliff. That 95% failure rate study you mentioned.
Yes, despite the $30 to $40 billion that was poured into initial enterprise AI investment in 2025, the evidence shows that infrastructure is racing wildly ahead of proven, profitable business model adoption.
And why is the failure rate so high?
Well, it turns out that integrating these AI models often requires substantial and unexpected integration costs. There's a massive internal skills gap, and crucially, a lack of clean, proprietary data that's required to customize the models effectively.
So the financial structures are basically predicated on a massive immediate adoption curve.
That the operational evidence suggests is simply not materializing yet.
When capital flows this fast and the pressure of competitive necessity overrides stable economic fundamentals, history offers not just lessons, but a pretty clear structural roadmap of the risks involved.
It really does.
And to understand the current AI cycle, we have to look to the long-wave framework developed by the economist Carlota Perez. She argues that all major technological revolutions follow a predictable, wave-like pattern of financial exuberance followed by consolidation.
And this AI cycle fits so neatly into her model, it's almost spooky. Perez divides every major technological revolution from, the canals and railways of the 19th century to the rise of IT into two distinct phases.
The installation phase and the deployment phase.
That's it.
So let's define where we are right now. We are clearly in the installation phase.
Oh, absolutely. We are firmly in the installation phase, which Perez aptly calls the frenzy.
The frenzy, I like that.
This phase is characterized by explosive technological innovation, financial capital chasing pure speculation, and crucially, for our discussion infrastructure being built rapidly, often far ahead of proven rational demand.
And valuations become detached from reality.
Completely detached from current profitability, as investors just extrapolate future growth indefinitely. The danger, as history shows us time and again, is that this frenzy inevitably leads to a massive market correction, a crash.
And the crash is what forces the necessary transition into the deployment phase.
Exactly. The deployment phase begins post-crash. It's characterized by production, capital focused on efficiency, standardization, proven returns taking over from that speculative financial capital.
And that's when the real value is created.
That's when the technology is broadly and rationally integrated into the economy, creating sustainable long-term growth. In the dot-com bubble crash, for example, that was the violent conclusion to the IT installation frenzy. But it cleared the way for the real value creation that followed at companies like Google and Amazon.
So the AI boom is exhibiting every hallmark of that initial frenzy.
Every single one. Dot-com level valuations, massive capex overriding economics, and a heavy, risky reliance on financial engineering like SPVs.
To make this abstract concept concrete, we can look back over a century and a half and find a really striking structural parallel.
The British railway mania of the 1840s.
The parallels are astonishing, right down to the financial mechanisms and the psychological drivers.
Absolutely. The mania was sparked by the undeniable success and profitability of the initial Liverpool-Manchester Railway.
So that was the proof of concept.
That was the ChatGPT of its day. It proved the viability of the technology, and suddenly everyone believed that railways were the only profitable asset class for the next 50 years.
And the financial conditions at the time created the perfect storm for speculative leverage.
They did. The Bank of England had cut rates, providing cheap credit, and crucially, stock purchases for new railway companies only required a 10% down payment. It allowed investors to buy on massive margin.
And there's the direct link to the AI boom. That 10% down payment is the historical equivalent of the leverage being created by modern SPVs.
It's the same effect. The mechanism is different. One uses margin trading, the other uses off-balance sheet debt, but the effect is identical. It maximizes leveraging power while minimizing the personal or parent company risk exposure to the initial capital outlay. It just enabled this rapid speculative capital formation.
And the scale of that mania was truly incredible. In 1845 and 1846, what was it? 263 acts of parliament authorized new railway companies?
Something like that. Investment surged to a staggering 7% of UK GDP. That was half of all investment in the entire economy at the time. Over 9,500 miles of routes were authorized across the country. Every town feared it would be left behind if it didn't fund a line.
The FOMO was real.
It was intense, and the outcome was a catastrophic overestimation of demand. By 1848, the market realized the severe overcapacity of the overlapping routes. About one-third of the authorized railways were never even built because the funding just dried up.
And many of the ones that were built
Yielded minimal returns, due to brutal competition and low utilization rates. The modern parallel is just crystal clear.
Yeah.
Cheap leverage via SPVs, rapid expansion blessed by governments as progress, and the ultimate risk of building infrastructure data centers, GPUs, that the actual organic market demand simply cannot sustain.
So if the railway mania shows the danger of building too much, then the fiber optic bubble of 1998-2003 shows the specific danger of capacity overhang in a rapidly evolving technological field.
Yes, and this is perhaps the most relevant parallel for the physical risk facing all these new data centers.
The fiber optic crash is so instructive. It was driven by this belief that internet bandwidth demand was infinite.
An article of faith at the time.
And so telecom companies and startups issued over $500 billion in bonds between 96 and 2001 just to lay these vast fiber networks. They built based on purely exponential projections.
But the technology itself, the ability to compress and transmit data faster, outpaced the actual consumer and business demand. It rendered much of that newly laid capacity redundant almost instantly.
The technological efficiency gains and the subsequent demand miss. It led to a sector-wide collapse that cost something like $2 trillion in market value.
It did. And the result was this massive capacity overhang.
Oh, yeah?
By the mid-2000s, an astonishing 85% of the fiber optic cable laid in the late 1990s remained unused.
The now infamous dark fiber.
Dark fiber. And the AI parallel is direct and, frankly, terrifying. We have $2.9 trillion in planned AI capex. The risk is that if AI model efficiency improves, say you need 10 GPUs instead of 100 for the same task in 2 years, or if a fundamental demand shift occurs faster than anticipated, that massive investment turns into the next generation of dark fiber data centers.
And this capacity overhang risk leads directly to the concept of stranded assets.
Or asset overhang. A commercial office building, if it's overbuilt, can be repurposed. You can turn it into apartments. But data centers optimized for specific AI workloads. They are highly inflexible and specialized assets.
So if the underlying technology shifts radically,
For instance, if energy-efficient neuromorphic processors displace the current reliance on GPUs,
then entire brand new facilities like that $27 billion Meta Hyperion complex we just discussed could become technically obsolete almost overnight.
and the final insult to injury here is the physical reality. The current GPU infrastructure relies heavily on massive power availability, which is also becoming constrained. So if a specialized data center is suddenly underutilized or technologically obsolete, its reliance on a massive dedicated grid connection further limits its alternative uses. It just amplifies the financial losses from the stranded asset.
So we have unprecedented leverage, it's obscured by financial engineering, and its funding capacity that faces a high risk of being stranded due to monetization failure and, historical patterns of overbuilding.
Potent combination.
So now we have to ask the critical question of timeline. When does this mountain of debt actually come due? The data points directly to a looming structural crisis concentrated in the 2026 to 2028 period.
And the credit markets, which are always the first to price in future risk, they already started repricing this vulnerability. The clearest signal, the absolute canary in the coal mine for the entire sector's financial stress right now is Oracle.
Why Oracle specifically? I mean, they're one of the most established legacy software companies. They have decades of proven cash flow, unlike some of these newer mid-cap AI infrastructure players.
It's precisely because they are committed to a legacy model while trying to aggressively transition into a hyperscale cloud and AI player. This dual mandate requires astronomical amounts of capital.
Right.
Oracle has committed to $50 billion in annual capex through 2028. But here's the critical part. They are only generating approximately $22 to $24 billion in operating cash flow annually.
That creates a staggering annual funding gap of $25 to $30 billion.
A gap that has to be financed purely through new debt issuance or asset sales. There's no other way.
It creates a continuous, almost existential need for financing.
It does. Over 3 years, this accumulates to a $75 to $90 billion net financing need. And that's on top of their already considerable existing debt load. Projections from credit analysts suggest Oracle's net debt will climb toward an astonishing $290 billion by fiscal 2028.
$290 billion.
And the credit market is now in full panic mode regarding the sustainability of this debt trajectory.
And we can see that panic reflected dramatically in their credit default swaps, their CDS, which measure the cost of insuring that debt against default.
The jump was incredible.
Wait, you're telling me Oracle's implied default risk jumped over 110% in just 6 weeks? That is an extreme market reaction that demands our attention.
Absolutely. The CDS tells the whole story. Oracle's 5-year CDS widened dramatically. It went from 60 basis points in October 2025 to 128 basis points in early December, a 113% increase in just 6 weeks.
And what does that 128 basis point level imply?
It implies a 5-year default probability of 9.2%. And for context, that implied risk level is comparable to the generalized corporate credit stress we saw at the height of the 2008-2009 financial crisis.
So the market is explicitly flagging Oracle's AI CapEx gambit as a structural severe risk.
It's screaming it.
When we look at the leverage profile comparisons, the contrast between Oracle and its mega-cap peers is just alarming.
It really is.
While the behemoths of the Magnificent Seven, like Microsoft and Meta, they have debt-to-EBITDA ratios that are, manageable. Microsoft at 1.5 to 2.0x, Meta at 3.0 to 4.5x.
Oracle sits at an estimated adjusted leverage of 8.5 to 10 times.
That divergence shows you precisely where the market perceives the systemic vulnerabilities lie. It's in the highly leveraged incumbents that are trying to catch up with these massive, unproven capital commitments.
Exactly.
But the problem isn't isolated to just Oracle, is it? It's a structural issue for the entire cohort of mid-cap tech and AI infrastructure firms that rely on the major hyperscalers for their revenue.
They're all facing the same temporal challenge.
Maturity wall.
The maturity wall is the single most critical structural refinancing risk, and it's concentrated in that 2026 to 2028 window. It's when all the cheap debt that was issued during the pandemic era comes due en masse.
What do the numbers look like?
The data from S&P Global is striking. Global corporate debt maturities, they rise from about $2.2 trillion in 2024 to a peak of $3.02 trillion in 2028.
So more than a 50% increase in volume needing refinancing in that single year. But it's the composition of that debt that makes it even scarier.
Correct. The most acute risk is in speculative-grade debt. That's the debt issued by companies with lower credit quality or higher leverage. These maturities escalate fourfold. They surge from $245 billion in 2024 to an alarming $1.1 trillion in 2028.
$1 trillion of high-risk debt coming due.
And in 2028, for the first time ever, speculative-grade maturities will actually exceed investment-grade maturities globally.
This creates the classic mid-cap trap. The debt that these AI infrastructure firms issued during the cheap money era of 2020 to 2023, when interest rates were near zero, matures precisely when interest rates are higher, refinancing costs are elevated, and potentially AI revenue monetization is disappointing.
They'll be forced to roll that debt at substantially higher rates, which will choke their operating cash flow.
And that cash flow choking scenario is exactly what makes firms like CoreWeave so vulnerable.
A perfect example. CoreWeave, an emerging AI compute infrastructure provider, is expanding so aggressively, growing CapEx 180% year over year, funded primarily through debt.
But look at their customer concentration.
62%. They rely on Microsoft for 62% of their revenue.
So they face acute refinancing pressure if two things happen simultaneously. First, Microsoft shifts its workloads internally to Azure, which it has an incentive to do to justify its own CapEx.
And second, if interest rates remain high in 2026, 2027 when all their debt comes due.
That is the risk. If the anchor tenant pulls back even slightly, or if the cost of rolling that debt jumps 300 basis points, the entire financial model just collapses. The market will not forgive such dependencies and high leverage in a tightening credit environment.
The risk, then, is not isolated. It's not just about whether an Oracle or a CoreWeave can survive their refinancing crunch.
It's about how this vast quantity of financial debt, often obscured by these SPVs, interacts with other hidden structural liabilities to create systemic vulnerability across the wider financial system.
And we have to introduce two other critical dimensions of debt that compound the financial risk, even though they don't show up in traditional GAAP accounting.
Okay.
We call them security debt and organizational debt. And these are liabilities that will inevitably drain future cash flow.
Start with security debt. This sounds like the deferred cost of prioritizing speed over safety in this frantic AI deployment race.
That's the core of it. Security debt refers to accumulated deferred or inadequate security measures. We're talking unpatched vulnerabilities, insufficient investment in cybersecurity protocols, rushed integration efforts.
All because organizations want to rush their AI systems to market to maintain a competitive edge.
Exactly. And this risk becomes systemic because an unpatched vulnerability in one AI model that's used by 100 downstream companies can cascade across the entire system,
leading to catastrophic data breaches.
And the liability costs for remediation, regulatory fines, legal fees, they could potentially run into the billions. And that hit to the bottom line comes exactly when companies need cash the most.
And organizational debt addresses the internal stress points of a company trying to scale too fast without the necessary controls in place.
Precisely. Organizational debt encompasses governance gaps, inadequate talent acquisition in key areas like accounting and compliance, and underdeveloped internal controls that result from breakneck scaling. The CoreWeave S1 filing provides a perfect example of this.
What did it say?
They disclosed a material weakness in internal controls over financial reporting. They cited gaps in accounting personnel and IT automation. And they expect deep weakness to persist until at least 2026.
And this isn't just an internal audit issue?
No. In a high-leverage environment, governance gaps can quickly translate into financial disaster or regulatory sanctions that impair cash flow.
So if we connect these three debts, financial, security, and organizational, we get a powerful negative feedback loop that exponentially increases market fragility. Let's just walk through that scenario.
Okay, imagine Company X is already strained by aggressive financing gaps. That's their financial debt. To conserve cash, they cut corners on security patches and compliance audits. So they're accumulating security and organizational debt.
Right.
Then a major breach occurs due to a known vulnerability. It costs them $5 billion in immediate liability and remediation costs. That's a massive cash flow impairment.
So now the company misses its crucial cash flow projections.
Correct. And the credit markets, witnessing the deterioration in actual cash flow and this material weakness in governance, they reprice the risk wider, just like we saw with Oracle CDS.
And that makes their upcoming refinancing prohibitively expensive.
Exactly. The subsequent financial stress then impairs the company's ability to invest in fixing the security debt or hiring the necessary personnel, and the cycle just continues downward. It amplifies risk exponentially across the whole system.
This sounds like a recipe for correlated losses across the market, which is why regulators are starting to issue some serious warnings about this systemic risk.
They are. The Bank of England's December 2025 Financial Stability Report explicitly flagged AI as a source of heightened systemic risk, not just technological, but financial.
And their key warning was about
Interconnection risk. The deep, concentrated links between AI firms, hyperscalers, and the credit markets mean that if one large firm fails, or if valuations correct simultaneously, the losses could cascade violently throughout the entire financial system.
And their action plan reflects this deep concern. I saw the BOE is planning a stress test specifically aimed at the private credit ecosystem. Why target private credit as the source of contagion?
Because private credit has become an absolutely critical yet almost completely opaque funding channel for this boom. Estimates suggest that private credit funds could fund over half of the $1.5 trillion required for data center expansion through 2028.
Over half.
And this concentration creates systemic fragility for two key reasons. First, these deals lack the public bond disclosure requirements. That makes aggregate exposure, figuring out who actually owns the $800 billion in shadow debt, incredibly difficult to assess until it's too late.
And second, there's the issue of recursive leverage.
Yes, the private credit funds themselves often use leverage. They borrow money to lend money. This creates what's called recursive leverage, where highly levered tech companies are borrowing from highly levered credit funds.
Plus the market turns.
The speed and the opacity of the losses could be sudden and severe. And it wouldn't just impact the tech sector, but the stability of the entire private lending sector as well.
Let's synthesize the critical findings of this deep dive then. We've analyzed a clear path-dependent cycle, and it's fueled by technological ambition and incredibly complex financial engineering.
Right.
Uncertain demand justifies massive CapEx commitments. Debt, primarily hidden through SPVs and these long-term offtake agreements, funds that CapEx. Credit markets initially absorb this issuance, but then they begin to reprice the risk wider, as we saw so dramatically with the deterioration of Oracle's CDS.
And finally, the maturity wall hits in that 2026 to 2028 period. That triggers an acute refinancing risk, just as enterprise monetization is expected to either stabilize or, well, fall flat.
The conclusion, when viewed through the objective lens of Carlota Perez, seems almost unavoidable.
It does. The current installation phase, marked by financial frenzy, overcapacity, and leverage, will inevitably correct before the true deployment phase can begin. That crash is the necessary inflection point that clears away the overleveraged players and forces the market to adopt rational, production-driven capital allocation.
So what are the three most likely catalysts that could trigger this correction over the next 24 months?
I think we see three primary triggers converging. Number one, and the most probable, is enterprise AI monetization disappointment. If that 95% failure rate persists into 2026 and 2027, data center utilization will fall far short of projections, leading to rapid cash flow impairment across the sector.
Okay, number two.
Number two is the maturity wall coinciding with elevated interest rates. If rates remain high, companies with these funding gaps will simply struggle to roll their $1.1 trillion in speculative-grade debt that's maturing in 2028.
And number three.
Number three is a materialization of one of the non-financial risks, a major security breach or a crippling physical constraint.
And here's where it gets really interesting to me, connecting the financial risk back to physical reality. The financial engineering we've detailed, the SPVs, the debt, the leveraged expansion, it all assumes unlimited physical capacity for the build-out.
A dangerous assumption.
What happens when these artificial financial structures meet the tangible hard ceiling of reality, specifically the emerging power constraint?
That is the ultimate tension. Wait times for securing multi-gigawatt grid connections now exceed 4 years in key data center hubs globally. We saw the systemic fragility exposed during the 2024 Virginia data center power incident, where a system failure caused dozens of facilities to disconnect simultaneously. The financial models projecting unlimited capacity growth are now colliding head-on with the physical reality of limited energy supply.
The implication for you, the listener, is clear. The period from 2026 to 2028 is a critical inflection point where these financial models are going to meet reality. The winners of the AI revolution will ultimately be those who maintain discipline around leverage and focused on proven organic monetization.
Not those who relied on the most complex financial engineering to sustain the frenzied pace of the initial build-out. Discipline around capital allocation will be the defining trait of survival.
A truly sobering analysis of what lies beneath the technological headlines. Thank you for joining us for the Deep Dive.